Welcome to the Broken Pie Chart Podcast, episode 223. I'm your host, Derek Moore, and with me once again is my semi-permanent co-host, who is more permanent than semi-permanent these days, Jay Pestrichelli. He is the CEO of ZEGA Financial. Jay, what's going on today?
Hey, Derek, surprise. I wasn't supposed to be here, but we got it in right before I'm taking off next week. So I'm happy to be here at episode 223, which, by the way, is a prime number. I know you love it when I Google that, but just in case you wanted to know, it's a prime number.
Does that mean markets are going up or down tomorrow? Do we know? By the time people listen to this, I mean, it's Thursday. We're taping this. So you can just tell us. And if we're wrong, nobody would have been able to act on it anyway, right? So,
yeah, I'm not allowed to tell you. That's the only downside.
Okay. Well, what I am allowed to tell everyone is last week we touched on the whole idea of everyone wants to buy a home, and there are really good reasons to buy a home. There are reasons not to buy a home. And this whole, renting versus owning. I did find the graph. It's where is homeownership premium the highest? And I think what they did here, who did this? It's kind of this is a source says Redfin Home Value and Rental Estimates in Freddie Mac. I don't know who put this together though. So anyway, they look at the analysis assumes a 5% down payment and 6.5% mortgage rate. And Jay, what it tells us is all of 4 out of, I don't know how many of these are, only 4 of them, but the majority are saying that there is a ownership premium. And I think what that means is what, Jay? It's if like for like
right, cost you more to own, to buy the house with that criteria, right? 5% down, 6.5% mortgage, than to rent, right? So you're right. There's 4 cities where there is not a premium, and I will call those cities out, where it makes more sense to finance. I guess the numbers work better for you to buy versus rent, and those cities are Houston. That's actually pretty good city, Houston, right? For our Houston listeners. Then Cleveland, Philly, and Detroit. So I could see why Philly would qualify, because who's going to buy in Philly? I'm kidding for any Philadelphia listeners. Derek and I are New York Giant fans, and so any chance I get to bash Philly, I will. But only those are the 4 cities where it actually makes more sense to buy than to rent right now, which is interesting. There's some of these cities, it's a humongous premium, right? The extra cost.
Give us some examples, Jay, and kind of explain how much the premium really is.
Yeah. So let's just, I'm going to take the middle of the road. I think this is probably 50 markets, right? Let's just take kind of the middle of the road here. All right, well, let's take Nassau County, New York. That is in Long Island, I believe. And the premium, it costs you more, somewhere in the neighborhood of 80% more. 80% more, so if you're spend 80% more to buy than to rent. So if your rent was, $1,000, it's saying to buy that same space was $1,800, right? When I look at that number, that's what 80% more means. Does that make sense to you, Derek, on this chart?
Yeah, I'm looking at where Nassau County, and it is in Long Island. I've been to Nassau County and have friends who live in Nassau County and still do. The way I read this, okay, so they have the ownership premium at, I'd say, around 30%, but then you go off to the right, share cheaper
that one's
to
30.
rent.
Sorry. Yes, you're right, 30.
Yeah, so I think what it means is, you can tell, folks, we don't record this or edit it, is the share that's cheaper to
Derek
rent.
being nice, like, Jay, you're a moron. Thank you for
No,
reading the
it's
chart wrong.
not. I think what they're saying is like over 80% share of the inventory, I guess. I don't know, or whatever it is, it's cheaper. Only like 15% is cheaper to buy than to rent. And then you have that ownership premium. But Jay, Nassau is not even the biggest one, right?
Oh, not even close. I picked the middle, right? If you get to the top of this, I can at least read top to bottom, Derek. So thank you for giving me a chance to redeem myself here. San Jose, California, over 150% premium uh, over renting, owning over renting. San Francisco, about 140. Oakland, California, 100. Anaheim, California, looks like 90. Seattle, 90. LA, maybe that's 80. San Diego, 75. Hey, there's a lot of California on this list, Erica. Those are the top ones that I just rattled off. Interesting. Denver's up there.
It's a sample size of one street, but where I live in Scottsdale, I can tell you I continue to see a lot of people who are newer to this area came from California because they can sell their house for much more there, come over here, pay much less than taxes, much less than property taxes, buy cheaper, and for any number of reasons they've come here. So you don't have the water here. We don't have an ocean unless California drops off. For they always that was the joke for a while. At some point we'll have beachfront property because California is earthquake prone. But yeah, I mean, look, I think that the thing. Let's bring this back to people and to people who are. And we know in our audience, we have individual investors, we have individual people, we have institutions, we also have advisors who listen to us. And I think it's the discussion about whether you should buy or rent is sort of, you have to take this into account. And there's any number of reasons why you want to buy, you want to have a home. But we showed last week, Jay, that the thing that nobody talks about is when interest rates are above 7%, which I've seen now in 30-year mortgages, each payment that you're making, you're only paying a really small amount to your principal, Jay, right? So it's almost like, oh, I don't want to throw money away renting. But then again, you're basically, your interest and your rent is sort of the same thing.
You pay the
So
bank first, right? That's the
yeah,
way those payments are organized. Yeah, sure.
where does Florida? So I see Miami has a little bit of a premium, but West Palm is and Fort Lauderdale. So
We're almost break even. Like we're right there, right? It's kind of a coin toss for West Palm and Lauderdale. You're right. Miami has a premium almost as much as Phoenix, right? I see Phoenix, you mentioned where you are. It's like a 25%. And I know it's not exactly where you are, but yeah, Miami, a little bit of less than Phoenix. So interesting that Florida and Texas end up being on the bottom of that list. Interesting.
what else is interesting this week, Jay, is can I, it's not a rant. Maybe it is a little bit. I'm seeing a lot of stuff. I always see these articles. Well, I have to do it. So,
No, you got to let it out, man.
yeah, well, this was an article. It was how inflation and higher interest rates have reshaped car buying. So, this is the most obvious headline ever. It's, of course, when you have inflation, meaning prices go up, and you have interest rates going up, that people's ability to buy cars or their costs go higher. But here's the thing that I look in here, and it's the quote. With a typical subprime auto loan rate of 17.9%, the monthly payment on a $43,200 loan for a new vehicle would be $983 a month. That compares to $720 a month for a buyer with a top credit score of 6.2%. So I look at this and I'm reminded of the Rolling Stones song, "You can't always get you what you want, but sometimes you get what you need." Like, if 17.9% and a $43,000 car loan is too much, nowhere in the article says, well, just buy it. You don't need a $43,000 car. Maybe you should look at a lower price car. I don't know. I think it's crazy.
Have you gone shopping lately for a car?
I have not in 15 years, Jay. What am I missing here? What am I missing? Like, what do I
It's
get
hard to
for?
buy a car for less than $43,000 these days.
Is it? Is
Certainly
it
not new.
really?
Yeah, I think so. Yeah, it's not. Yeah, it's definitely. Unless you want to buy like a 10-year-old car, right? Like that's my pushback on that comment that you have. Like, yes, maybe you don't have to spend 43, but have you looked at what your Jeep costs new these days? Right? It's a
Mm,
lot. And it's a Jeep. Although they have improved Jeeps ever since. I think. Do you still have yours, by the way? Now
I
that I'm
do, the
throwing it out.
2008. Yeah.
Yeah, I have
Lifetime
a 2010.
transmission. Yeah. All right. Well,
Yeah,
I'm going to
they've
push.
made them much nicer since we bought ours.
All right. Well, I'm going to push back a little bit. And here's what I'm going to tell you. I'm looking right now. I pulled up CarMax, and if they want to sponsor the show, I'll consider it for a very hefty sum. But 2021, 50,000 mile Honda CR-V EX. Not that familiar with the car. $27,000. You know, could you do? Is that an okay car? Ford Fiesta SE. They still make Fiestas. 2012. 105,000 miles, $11,500. I don't know how
It's an
long it
old
will last.
car.
It's an old car, but I mean, I just told you one, a 2021 Honda CR-V EX, $27,000. I don't know where this. I'm going to see it right here.
I don't know where that is. I don't know where you're buying a 2-year-old car for $27,000, but okay, if you say so.
I'm on CarMax's site. This is CarMax Phoenix West Valley.
I'm sure those car salesman sites would always be honest with you. I'm sure it's exactly.
You know what CarMax, there's no haggling. You just go there and the price is the price. They give you a price for your trade-in. And I think you're probably paying more than you would on a private party, but I don't know. I mean, I'm just telling you, like I just told you, $43,000, 7.9%. Would they be better off with a $27,000, 50,000 mile to 21 Honda CR-V? I have no idea what this car is even. I mean, I'm looking at pictures right now. All right. My point of all
listen,
this,
I would love for people to send in their comments and tell you what they paid for their most recent car purchase, if it's been in, say, the last year.
I'm
I would
looking
love
at
to hear it.
CarMax's site now. I mean, I'm telling you,
Whatever. Nobody's buying that car. It's a lost leader. No one's buying that car.
here's a Camry, 14,000 miles, 2022 Toyota Camry SE. I don't know what the SE stands for. Something excellent, maybe. I don't know. $30,000. I mean, I'm just telling you, there's cars on here. There's a Chevy Cruze from 2015. This is the last one I'll tell you. Yeah, I mean this one's available in the Phoenix area. It must know my location because it keeps giving me Phoenix
They
area.
must know. Maybe the cars are cheaper there, but I'm telling you, I don't know of anybody buying cars at that price. Especially, well, car prices, especially used car prices, have definitely been on the rise, and you know this, right? When you look at the inflation data, and I think it's great that there are some listed there. I just don't think that's what people are paying for cars.
All right. Well, cars though are, I mean, yeah. Well, let's
You
move
can always
on.
find something cheaper, Derek, but who knows what the deal is with those things, right? And how that goes with the loss leaders to get people to go in.
Yeah, no, that's true.
I'm going to
It's
call
like,
shenanigans on all those.
I
Now I
don't
got to
know.
go. Please everybody comment on what you paid for the last car, and help us get real.
Yeah,
Let's get some real data
send
points.
send those emails to derek.moore@zegafinancial.com, derek.moore Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial is up to you to spell correctly.com. All right, we'll wait for that mail. I look forward to it. What I want to transition to, Jay, this was Tobias Carlisle had put this out on Twitter, and it's referencing a Wall Street Journal article where the M score, which is signs of accounting fraud, are rising. And what they're saying is that anytime this gets up there, we tend to have a recession. Although on this graph, there was no recession after 2012. It got up close to 0.5%. For anyone who's wondering what is an M score, I'm probably mispronouncing this gentleman's name, but Masad D. Beneish, Indiana University, came out with the M score. And it's a way of, I guess they look at companies and different metrics in their financial reports, and they try and see when it's more likely or not likely that there's fraud. Jay, I don't think we're saying necessarily we know of any fraud or anything like that, but the M score is higher. But I will say, and I'll link to this in the show notes, there was an article about companies juicing profits. And by juicing profits, by totally acceptable accounting standards. Like I think they mentioned Google said, our servers are going to last longer, so that changes how much you have to take in depreciation, so your profits go up. I don't know, Jay. Any thoughts on this?
Yeah, I mean it's I have heard of the M score before, and I have seen it circulate in the past. I feel like it doesn't take into consideration things like change in tax code and all of the small business filings versus large business, what you can write off, those kinds of things. Like those things change over time. And so, I know this data that we shared that you've got here goes back to 1980. Things are very different, right? So, fraudulent accounting practices is, I just think it's a hard thing to kind of gauge, then tie it to tie it to the market. I'm kind of I'm kind of meh on this one, buddy. Sorry, I'm going to put it in the hard to tie it to anything category.
Yeah, I'm probably right there with you. I hate to say we agree, but we do. And the Wall Street Journal article, I'll link to in the show notes. They make the point that some companies are reallocating cost, unwinding charges, delaying depreciation, using non-traditional ways to boost the bottom line. You can read that if you go to in the show notes. Um, yeah, I don't know. There was an interesting thing though. You and I. So I'm gonna go to our next topic, and that's this idea of companies that get into the top 10 weighted basket of the S&P 500. So Apple is the biggest market cap. So market cap is the share price times the number of shares. And I think Med Faber put out something on Twitter. He runs some different funds. He hosts a podcast as well. And what he put out was actually, Jay, you want to take us through this one?
Yeah. So I'm looking at which one of these you're referencing here. Is it the average annualized outperformance?
Yeah, that one. Yep.
Yeah. So essentially, when the years before companies get into the top 10 or considered in the top 10, their performance is fairly strong. Like 3 years before, the average return is 24%, 5 years 19, and 10 years 10%. So essentially, as these companies have higher performance, and then they get into the top 10, their performance after that is lackluster at best, right? Virtually flat. 3 years later, 0.7%. So not even 1%, right? 5 years later, negative 0.6, 10 years later, negative 1.5. And essentially what it's saying is, hey, once companies really kind of get into this top 10, they don't do so much, they don't do so well afterwards. And it looks like this is research from, it says 1927 through 2020. So it's a little dated here, but I do think it's interesting that we've all heard kind of the law of large numbers. But I will so I'll pause there, Derek, if you wanted to comment on anything there before we, you know, hit the data up a little bit.
I mean, to get into the top 10 companies in the US, you sort of have to do really well before you get in the top 10. So, I guess in some ways it's not surprising. Um, yeah, I mean, and also this is it doesn't necessarily say the S&P 500. This is total US market. And when I initially saw this, I said, well, yeah, take a company like Tesla who gets into the S&P 500 after they're huge. They came in as a top 10 company. But no, this is just the US market, Jay. So I don't know. I mean, I think of course you have really good performance to get to the top 10.
Yeah, of course, right? But I think the question or what they're trying to, I mean, and I know why you decided to pull this stat for the discussion today, but and we'll get to that in a second. But to get there, you have to perform well, and then this graphic would tell you like, once they're in there, they don't perform so well. But I feel like we're in a different age with the $1 trillion market cap companies, right? Apple broke that. Amazon did it, right? So I mean, an Apple now is over 2 trillion, I believe, as it pressed towards a new high today. We're getting closer to a new all-time high in Apple. Yeah. So like, which is it? Which can we just use that as kind of the poster child as to why this data may or may not be relevant anymore?
Do it.
Right. Apple was in the top 10 in the 2010s. Derek, you were nice enough to kind of pull a list of kind of the top 10 largest companies by market cap by decade. So you've got like 1980, where you had IBM and AT&T as the top ones. GE was in there too. Exxon is in there. That's interesting because then you take a look at 1990, everything kind of changes, right? It's all Japanese, a lot of Japanese companies that are in there in the 1990s. IBM still in the top 10, though. Exxon still in the top 10. Okay, the only two US companies that are in the top 10, world's largest. Then you get to the 2000s, back to a lot of American companies. Microsoft, GE's back in that list. Walmart makes it in. Exxon's still in there. Oh, okay. Exxon's still in. So Exxon's been in now for the 80s, 90s, and 2000s. Jump to the 10s, 2010s, and Exxon's the number one company. Apple's now in there. Microsoft is in there. It is a little more diversified list. There's some now Chinese companies that are in there. PetroChina is in there. ICBC is in there. Looks like there's a bank from China that's in there. Okay. And then you jump to the 2020s and you've got almost all American companies: Apple, Microsoft, Alphabet, Amazon, Facebook, Tesla. Burke is in there. Unfortunately, it looks like Exxon fell out of that list now for the most recent. But I guess when you look at like an Apple and Microsoft, and you look at Exxon, you look at GE. Sometimes companies get in the top 10 and stay in the top 10 for quite a while. It's not the kiss of death of getting into the top 10 and then you're just dead money. That, to me, I would say, a little bit of a stretch there, right? To say that's always the case, because we've got some evidence where they stay in the top 10. And by the way, the markets grew right through a lot of those periods. So those companies grew along with it to stay in the top 10.
What do you think indexing has had, the effect of indexing? And I bring this up because if the market, people keep buying, and if you're already in the top 10, and if people keep going into the index, you're going to keep getting flows into your stock. I mean, don't you think that is one of the differences maybe of the era today than it was? I mean, it wasn't until the late 1970s when Vanguard came out with index mutual funds that really things changed. And it wasn't until the early 90s until we had the spiders. SPY was created, and that was revolutionary at the time. People forget that. So don't you think that plays a role?
Well, sure. And you look where a lot of fund flows go these days. It is into, funds, ETFs and mutual funds, more ETFs these days than mutual funds, I think. So, but yes, and a lot of them hold the stocks that have momentum, right? And of course, right. So it's, maybe somebody's not actually buying, Meta slash Facebook, but they're buying it when they're buying the index, right? And you own a piece of that. So I think that's definitely a piece of it. I also think that the world. It's just. I mean, I shouldn't even comment on this one. This might be a whole nother time, another discussion. But it's just so much easier now to buy the products you like and love by yourself. Right, with the advent of I came from the online brokerage space, but it's even easier now, right? The Hoods of the world are making it even easier and more convenient for everybody to buy shares of what they use and like. And when you look at the companies that I rattled off, Apple, Microsoft, Alphabet, Amazon, Facebook, Tesla, those are companies that a lot of people used every single day. So the fact that they show up is not surprising to me in the top 10.
You look today, and Google has two places in the top 10. But interestingly enough, now I asked, I had to do a little AI, Jay. I love it. And I use Bard, Google, for this because it seems, as far as data, you can look at a current data set. So I asked it, give me the top 10 today. It gave me 9. Okay, whatever the reason. And it's actually 8 because Google is listed twice. So I'm going to argue with Bard after this podcast. Exxon XOM is number 8. So they're back in the top 10. You
They're
look at
back
this
in
list.
now.
Yeah, they're according to Bard. I haven't checked this because it's sometimes I know when the data is not right, and I did some stuff and I can't use it because I know it's not right. But just looking, I mean, Apple, Microsoft, Amazon, and then I got to add the two Googles together. It's 3.4. So Google's actually third, Amazon's fourth, Nvidia's fifth. And Nvidia's move has been really, I mean, it's over $1 trillion right now. But, you made the point of 2010. If we go and I look and I ask Bard's AI thing to show me, just the U.S. stocks, the S&P 500, and I'm looking here. I mean, the 2010s, it's pretty much. I mean, Exxon was number two at the start of in 2010, but Microsoft's still there. Amazon, Berkshire, started 220. I mean, same stocks: Apple, Microsoft, Berkshire, Alphabet. And then look where we are today. Like these companies are. I think you're right. It's different, and I don't know what these companies are going to do. But I mean, come on. I mean, it's like just because these companies are the biggest now doesn't mean necessarily that they can't keep getting bigger. I mean, but I don't know. I don't know, Jay.
Yep. Well, I guess time will tell. And there's always that theory, right? Once you're the biggest, you won't be anymore because of the law of large numbers. But that has definitely not been the case in recent years, for sure, right? The biggest have remained the biggest. By the way, it feels like the way that this market is going with what the Nasdaq is doing, the biggest are only getting bigger.
No, I think that's right. By the way, why did Google have to go and makes things so confusing? Come on, just list
Could
once.
could you be more
Why do
specific?
you got to list yourself? I know it's because of the voting and all that. I don't.
Oh, why have two tickers? I
Yeah, like
got you.
why are you listed twice? Why are you going to make things difficult for everybody? Just one ticker. Figure it out, Google. All right. Anything else on this? I would just say another chart. Also, Med Faber posted this. Source was Goldman Sachs, and they make the point that the five largest stocks in 2000 were Microsoft, Cisco, GE, Exxon, and Intel, and they made up the weight of those collective five stocks was 18%. Today, it's 23%, and it's Facebook, Amazon, Apple, Microsoft, Google, and it's other Google. So I think, and a lot of people would look at that and say, "Oh yeah, see, we wouldn't want to." Remember though, this is the weight in the S&P 500. If you own the S&P 500, we like to index, we like to hedge on that index, of course. But Jay, I mean, this is the case for indexing. As stocks do better, you own more of them, right?
Yeah, I mean the index naturally, will rotate and have more of what's doing better. I will say that it's just it's such a convenient way of investing, especially for the casual investor, who's just like, well, I know I should be saving. What should I buy? Using funds like the S&P 500 are really it's a great way to get that exposure. Derek, I feel like it's like the dirty little secret of our business that, as you're, trying to accumulate wealth in the early years, right, of your savings and investing, just buy an index fund, buy the S&P 500 or buy the Qs, if you want to be a little more risky. It's just one of those things that it makes life easy. Having an advisor like you or me build portfolio plans for you, not until your assets are of a sizable amount where they need special consideration does it always make sense. So, I tell, a lot of friends and family that come to me and say, what should I do? I go, buy the S&P, open up an account at Schwab or TD Ameritrade or Fidelity and buy shares of the S&P 500 when you can pay yourself. It's the easiest thing to do. And the S&P just will beat 90+% of managers out there. I know I've said that before on this podcast. It's one of those things that, it's so convenient now to make investing simple. Now, it's just, you should do that, right? Like, sorry if, financial advisors are listening and they say, why don't tell people not to come to us? You all know the truth. The S&P is the benchmark. Now, look, there are times where you need to take less risk. Great. Then you have somebody help you manage your risk. There are times where you need to be more aggressive. Great. Have somebody help you with that. But, generally speaking, for investors just starting out, it's a great way to build wealth. Get over 100,000, 500,000 at that point, it may make sense. Talk to an advisor about where you want to take your risk. Fine. But this is just the best way for the the beginner starting to invest, use the SPY. Sorry, or a SPY equivalent, IVV, or I forgot Vanguard's one. Is it VOO? No, that's not it. I forgot the Vanguard index ETF. But there you go, Derek. Sorry, now I went off on a rant.
I'm glad you did,
I
because
let the word out.
we didn't talk about this at all. But I've had people ask me, and I've honestly said to them, "You don't need me yet." And the other thing I say to them is, don't, and I say this sarcastically, it really doesn't matter right now what you're investing in. And then I tell them the same thing you tell people. It's look at indexes. And the reason why I tell people that is, if there's someone who's younger and they're starting out, like, you really shouldn't be that worried about the returns. And this doesn't mean that it doesn't matter what you invest in. You shouldn't throw your money in fake crypto coins. And there's plenty of those to choose from.
I was like, you're going after crypto. I felt
Yeah.
it coming.
Or just, let me put all my money in one stock that's going up right now. The reason why returns don't matter at this point,
That's too hard.
well, that, of course, it's too hard, but it doesn't really matter. Like, all right, let's say you have $1,000 in an account, you're starting out, and you get a 10% return. Congratulations, you made $100. Like, whether you made 5% or 10%, who cares? The greatest impact that somebody is going to make when they are starting out investing before they have a lot of assets is to contribute. Like, if you bring $1,000 into that same $1,000 account, you just got 100% increase in the value of that account. That is much more valuable than getting 5% or 10% or 20%. Like, it doesn't matter at this point what you're going into. Like you said, Jay, pick an index fund, pick the Qs, pick the SPY, whatever. It really doesn't matter. You should be, and I've made this analogy before. It's like the Billy Bean stuff, the Oakland A's movie where Brad Pitt plays Billy Bean, and it's, everyone's focused on the wrong things. You should be focused on growing the account. And it doesn't necessarily matter. You're not trying to outsmart the market at that point, because it doesn't matter. If you get 12% versus 20% on $1,000, it's an extra $80. It doesn't matter. So I'm glad you brought that up, Jay.
Me too. Thanks, Derek. I'm not surprised we tell people the same thing.
All right, let's pivot to a little stuff in our wheelhouse, and that's volatility. And Jay, the VIX did something it hasn't done since November of 21. What did it do, Jay?
The VIX closed down at, I think it was 15.6, 15.65 at the lowest level since November 2021. And what do we do a quick little overview on the VIX? Probably makes sense, right? The VIX is the volatility index, which is essentially a forward-looking volatility predictor, meaning how much movement is the options market pricing in over the next 30 days. And the lower that number, the lower the volatility is expected in the S&P 500. And that number is low, which means there's not a lot of volatility expected around the corner. Volatility being, dramatic up and down moves. So what it's telling us is you'll have mild moves, right? A 15 vol is definitely much more mild than its average, which is around 20 as a reference. So even though, there was a lot of fear baked into this year, and we're just coming through the debt ceiling discussion and, potential banking crisis and whatever else is on the horizon, the volatility, the options market is projecting not a lot of volatility over the next 30 days.
Doesn't mean anything. I went back and I looked at November 19th of 2021. I couldn't, when you look at a chart, Jay, and you got to move the cursor, I can't get it to stop on the 21st, but it's close enough for government work.
Okay.
So, right under 4,700 was where the S&P was. It goes on to make a new high, a new all-time high. Probably, I think it was that very first week. Oh, you know what this is? It's a weekly chart. That's why I can't get to it. But it makes an all-time high very shortly after that. And thinking back to 2021, I think a lot of folks said, well, the market's not cheap. It's a little expensive, but nobody was really that worried about a crash. So the fact that it is similar in the expectations to when the market was riding to all-time highs, I mean, don't you think that's a little bit significant? Like, what does it tell us about the posture on the street and the sentiment?
So look, you and I both know that the VIX number by itself isn't the most important piece about it. It's where it came from to get there. So this dropping volatility, right? So we were trading I think we had probably, we saw a 30 VIX or 25 VIX for parts of this year so far. Certainly when the banking, whatever we'll call it, the banking crisis that we had back in March came, we saw volatility pop. There was fear in the market. There were people, willing to speculate up and down. But I'm not, Derek. I think and I think you know exactly what you're doing when you say this. That was the peak. I think it was the peak of the Nasdaq in November 2021. Nasdaq's doing pretty well right now as a comparison. I don't know if there's any ties there, but I would say that you can't just look at that number in and of itself as as kind of a contrarian indicator, right? I mean, that's where a lot of folks look at the VIX as it's bottomed out, it's time for it to rise, and a rising VIX typically accompanies a falling stock market. But there's nothing that says the VIX can't go from 15 to 13, down to 12, down to 10. It happens, right? For the VIX to get down to the 10, 13 range, which has some significance, it has to pass through 15 first to get there, right? And it was above it, and it got down to it. So I'm not going to make the connection that a 15 VIX is the contrarian indicator that we're at the top on the market. But what I would say is there's not a lot of speculation either way. Like when I hear the VIX, a lot of people call it the fear indicator. I don't. I think it's more of a gauge of speculation than anything else, because you could have a lot of call buying that would also push the VIX higher. Usually it's put purchases, which is kind of a bearish position or a hedge. But I would say that this in and of itself doesn't necessarily mean that we're in a spot where the market has to go down and the VIX has to rebound. It could continue to go lower. So I'm not willing to make any statements that say, VIX is bottomed and that is a bearish signal in the market. I don't know if that's where you wanted me to go, but I don't think I can go there because it could go lower. It's been
The
lower.
mistake people make with the VIX is looking at a chart and looking at, support and resistance levels and thinking that, oh, it's got to bounce here and then it's go higher. And by go higher, it usually means the market is easing off. But I also I'm going to question the fact that we get the debt ceiling vote, or I guess they're going to vote in the Senate. By the time people listen to this, it will already be done. I mean, really? Did people really think the U.S. was going to default? I mean, you and I discussed different ways they have revenue coming in. Like they could prioritize the payments. I don't care what Yellen said. Oh, there's no way to do that. Really? Is the government that? I mean, maybe actually the government's that disorganized that they have no way of parsing out who gets paid and what. Maybe it just is on auto payment and they can't stop it. But right, Jay? I mean, like, did they really? Did people really think we were going to default? I don't know.
I mean, I think some people thought there was a risk. I don't think anybody in our shop thought there was a risk of that, right? Because the catastrophic fallout from that is just too large, right? That is just things would change dramatically across the globe, right? If our elected officials couldn't figure out a way to get that done. So yeah, well, look, apparently the market thinks like, oh, we're going to get a resolution to the debt ceiling. That's a good thing. Yeah, it is, right? The debt ceiling issue, but it's always been a good thing. And so to have a premium built into the market for that seems a little short-sighted to me, right? But the market went up today anyway, so there you
This
go.
really has been a re-rating story. Jay, we talked about last year. When I say re-rating, market multiple, and the market, and I think it's tied. I'm tying this into the VIX. When the VIX is very low, I think it shows that people are willing to pay up for growth, pay up for future earnings and cash flows. And I checked the J.P. Morgan guide to the markets, And the forward PE right now is what? It's what is it? 18 times, I think. Yeah, it's about 18 times. It's above the 25-year average, which is 16.79. But I wasn't that, I mean, a little bit north of 16 for a while, or right around 17. So you had earnings that weren't that as bad, and the forward estimates haven't dropped that much. So people are willing to pay 18 times the next 4 quarters earnings right now. I mean, we know the last 2 years it was a multiple compression, right?
Yeah, yeah, and certainly with having finally another alternative to put your money in treasuries, it makes it harder to have that PE ratio to be in this 18, let alone who knows if we get to 20 range. So I think there's a lot of different factors when it comes to looking at the forward PE and how expensive the market is. But if I could tie it back to the VIX
Yes.
for a minute, right? I almost feel like asking Derek, what are you supposed to do when the VIX is low? What do you do when the implied volatility on options is low versus what you would normally do when implied volatility was high? What do you do as an options trader?
Options are cheaper, Jay. They are cheaper.
Yeah,
And it's one of the things
yeah,
we enjoy with a lot of our strategies where we're getting long the market using options as to own the market, to replicate participation in the market without necessarily owning securities. But when things are cheap, it's a better time, or it's cheaper to buy and build portfolios, Jay, right?
yeah. Whether you're using options to replicate long stock or using options to hedge, the price of hedging is going to be cheaper when volatility is lower. There's less fear in the market, less speculation to the downside, so it is cheaper. We've used this analogy before, and I'll use it again. I don't think I've used it recently. It's almost like buying insurance. I'm in Florida. If there was such a thing as hurricane insurance, this time of year when we're just about to get to hurricane season, it's going to be a little more expensive than it would be, say, at the end of hurricane season, right? So when the expected outlook of more volatility and risk is built into the market, then buying things like hedges, where you're using, say, long puts as hedges, that gets more expensive versus when the outlook is, rosy, right? It's like, okay, we've made it through hurricane season. You could take your shutters off. You could put your furniture out in the yard again and not worry so much. Sure, we're happy to, buying insurance is cheaper because the likelihood of a payoff is less. That is something that I think is important to bring up because we talk about hedging all the time on the program here. But I think that looking at maybe locking in some gains as the market moves higher is something that some folks might want to do. If you really thought a reversal was coming, the beauty of the low VIX, and if you're using the low VIX as kind of a guide there, the beauty of that is it's also cheaper to buy your protection at the same time while you're locking in gains because you just had some appreciation. It's one of those things that at some point it's worth talking about.
I think it's always worth talking about. And unfortunately, people are most interested in protecting their portfolios at the most inopportune times, the most expensive times. And it's why, Jay, you wrote a book called Buy and Hedge. And what a great Father's Day gift to get people, don't you think?
Yeah, I mean, give people the gift of financial knowledge, and I think it pairs nicely with the Broken Pie Chart, the
That's
book that
right.
you wrote. I think they go
At
well
some point,
together.
Jay, we're going to write a book together, but we'll let everybody know what that. We haven't started that yet, but at some point,
We know the topic.
we do. How's that? We know.
It's gonna be. We know the
Yep.
topic.
All right, Jay. Let's talk a little recommendations, and we'll let us get out of here. By the way, do we have to just say that? I mean, I think Succession, quote unquote, landed the plane really well with their series finale. What'd you think?
Yeah, I thought it was good, right? They threw some curveballs, but they really stayed true to the tragedy of those characters at the end, right? I mean, really, I would call it a tragedy, right? It's entertaining. It's just plenty of comedic moments in that show. It's a tragedy, and I think the way that it ended was fitting. I don't even want to give it away, but it's definitely worth watching and putting in the time to get through it. They were true to the characters.
There was that episode where Logan had they met at the last time he was on. Well, anyway, he's on there with the kids, and he just says, I love you, but you are not serious people." And I think, yeah, I mean, the kids were just, they thought they were being serious, but they really weren't. So, all right, Jay, any recommendations this week?
All right, so I started watching a show. It's got 4 seasons out. I'm almost done with the first season. That has me laughing quite a bit. The name of the show is Brockmire, and it's a show about a baseball announcer who ends up having this very public meltdown, and how he ends up finding a home in a fracking town in Pennsylvania, I think, and it's funny. So the main actor is Hank Azaria. I think that's how you pronounce his name. He's Jim Brockmire. But Amanda Peet is in it, and she's hilarious. I always love everything that she's in. So, something that I don't know if you've seen it, but I would say worth taking a look.
All right, I will. And what is that on again? I didn't catch that.
I don't think I said which one it's on. I have so many of these at this point, man. I think it might be Hulu is where I'm watching it right now.
I found that it's probably putting a lot of like cookies on the computer and everything. But if I go to justwatch.com, you can type in a movie or a show, and it tells you where it's streaming and whether it's free or not, whether you have to be subscribed.
Oh, Brockmire, Brock. Yeah, Brockmire is the name of it. If you want to put it in, if you have that up, then we could know. I think I'm watching it on Hulu. I lose track.
Yeah. So Brock, let's do Brockmire. Let's see here. Brockmire, it's from 2017, huh?
Yeah, it's not that
All
old.
right.
There's 4 seasons, I think. I don't know if they're still doing it. I'm not through the whole thing yet. I just really started.
So yeah, stream on Hulu. So there you go. Hulu's the
All right.
The place. Apparently, if you have Sling or Spectrum, but I don't know I know what Sling is. Maybe Spectrum has an online thing. I don't know, but there you go. My recommendation, I'm going to actually go back to 2018, and my new Mission Impossible is coming out, and my son wants to go see it in the movie theater. And he thought it was actually coming out June 12th. I believe it's coming out July 12th. So he was disappointed when I told him it's not till July. But he watched every Mission Impossible movie. And, looking at Mission Impossible Fallout and Ghost Protocol, that's a double recommendation this week, Jay. I think both of those are really quality. I don't know if you've seen those.
I have. I haven't seen the new one. I think it was right because it's not out yet. But I would see it. I've seen. There's 3 of them, right? Is there 4?
6.
This one number.
There's 6 of them, I think.
Oh, all right. Then I haven't seen them all. So, Tom Cruise movies, right? Yeah. Well, I will. I would definitely watch that one, and they're good in the theaters, right? It's a lot of action. They go through a lot of great lengths to provide pretty good action. So yeah, it's pretty good movies. I haven't seen them all.
People have told me to watch the new Schwarzenegger on Netflix. So they did a play on titling, and they said they made him the chief action officer, which I guess is him saying, "I want more action now," that type of stuff. But no, it's absolutely
terrible.
awful. I'm sorry to the Austrian audience. Keep listening. I won't do that again. And but people told me it's pretty good, so I may have to check that out. But I don't know. We met him. I don't know if you were there, but we were on back in the day. We used to travel all over the place, and he was at a hotel where a bunch of us were doing an investment speaking thing, and he couldn't have been nicer. He was, shook people's hands, agreed to get in a picture with everybody, and so I have good things to say about Schwarzenegger in my one interaction with him. So there you go.
Well, good. Well, look, I will throw one more out as a little bonus as we're talking about things that are kind of coming up. Is if you're an It's Always Sunny in Philadelphia fan, I think June 7th, the first 2 episodes of the new season will come up. So while I previously bashed Philly, I do think one of the greatest things related to that city is that show. I've been watching it since it came out in '05, and they're still putting out new seasons. Always entertaining for me. Now, I've really kind of like showed my lowbrow humor with Brockmire and Sonny, but there you go. It's coming
All
up.
right, yeah.
I know I will watch that.
Philly has, if you like Philly cheesesteaks, Jim's Steaks is my favorite of the ones. I think it's better than Geno's, and I think one of them closed down. Remember that it was that building with the two of them? I thought one of them changed hands or closed down. I don't know though.
Yeah, I think in 2020 there was some shakeups there. So does Jim's do the Cheese Whiz or American or provolone?
Well,
You got to do Cheese Whiz, right?
yeah. Now if you say wit provolone, they'll give you, but it's wit whiz or wit provolone is the way they say it. And it's kind of like, if you take too long to order, you ask too many questions, you get looked at a little strange there in Philly. So be prepared.
No soup
for you. Exactly. So,
Yeah.
I mean, look, I got nothing against Philly, the city. I've been there a bunch of times and been to the baseball stadium. And, but yeah, as New York Giant fans, just can't root for the Eagles. I'm sorry. Can't do it. Can't do it.
Oh, they got our number. Hopefully this year they're not as good as last year, which
They'll
they
probably
were great.
be just as good. And next week will be just as good as well in this podcast. So Jay, thanks again for coming on and entertaining us this week. And we'll have you back again. I think you did enough today to earn another spot, Jay. So congratulations.
All right, enjoy without me next week.
All right, see you everyone. Take care.